here. So I run a company called Clearglass. Clearglass is the organization that sprung out of the work I did for the FCA about 3 years ago, looking at transparency in UK asset management and pension markets. And so I have a lot of data, and I'm hopefully going to get a chance to expose some of that later, but I'll pass the baton on instead to Matthew and tell you about that later on.
Thank you.
Hi, afternoon. Matthew Vickerstaff. I'm Deputy CEO of the Infrastructure and Projects Authority, the IPA. We report into HM Treasury and the Cabinet Office, so we're right at the heart of the UK government. And we're responsible for delivering the UK's most difficult, challenging infrastructure projects. About 250 people, and focus very much on publicly financed projects, but also privately financed projects, which I think is the subject of today. So that hopefully that will be helpful.
All of the above. Thank you. And Sean?
I'm Sean Kidney. I'm the CEO of the Climate Bonds Initiative. We're a global NGO focused on mobilizing capital for climate action. We work with institutional investors. Why? Well, actually, in a question when I was at dinner last night, Matthew, that came up, it's because of the long-term nature of the focus of institutional investors in a world dominated by short-term horizons. And we have a long-term problem, which is climate change. We've got to match the right parties with the right solutions to try and drive change. And that's what we're doing. And of course, we work on green bonds because institutional investors like bonds. They have a lot of bonds and they want the green bonds. And 2.5 trillion outstanding now, not too bad, US.
So let's give a baseline for this start of this talk. Where are we now? Where is demand now?
Okay, so I'm going to couple of caveats for the data. This is based upon a UK sample size. It's based upon about 1.3 trillion of UK institutional pension fund assets, so largely DB. The UK market is obviously larger than that. There are probably £6 trillion worth of additional institutional investors, including insurance, wealth managers, sovereign wealth funds, and so on. But this is a representative asset allocation, and also can be extended to Europe because the asset allocation for European pension funds is probably the same as we have in the UK. So it's a relatively vast sample size, 1.3 trillion, and there are about 2% of that is allocated to infrastructure. More importantly, government debt directly invested by pension funds is about 3.5% of assets, or £60 billion. The thesis I want to put forward, though, is that if you're looking to finance a green revolution through fixed income products, through debt, you're probably better off doing it through the private sector, because active and passive corporate bonds, rather than being 3.5% of assets, total more like 11% of assets, or £180 billion. So £180 billion of private debt versus £60 billion worth of public debt. It strikes me that you're better off using the private sector rather than the public sector.
Well, I'm sure that will be discussed. Matthew, tell us where you see this, set the stage for where you are now.
Yeah, well, I think it's really interesting. Chris has just set out very much from a UK perspective, the supply side. In terms of the demand side, absolutely agree with Sean. The energy transition, net zero 2050, the need to green our economy is absolutely critical for the UK. We were the first OECD country to legally and legislate that net zero 2050 was a target, but we also have other infrastructure to deliver as well. And actually, one of the things the IPA does is, on a rolling annual basis, do a look forward about the construction pipeline that the UK will present to the market. And we've recently done that, and that totals 650 billion of investment over the next 10 years. So that in a way is a demand side of things to marry with that supply side, private or indeed public, as I think Sean was alluding to in terms of green bonds. We recently in the UK issued a green gilt for 10 billion, our first, as it were, benchmark green gilt. The demand for that was absolutely huge. And Sean probably knows more about that than I do. So I'll hand over to Sean.
How did that go, Sean?
Nice segue. Well, 100 billion of orders, 2.5 bips, greenium. I mean, it's just another gilt, guys. But it got a 2.5 bits premium, and that's pretty common. So I'm going to say grossly, because your points about asset allocation are very interesting and worth noting. But just grossly, where we are now, the demand for green is very strong. Essentially, people are thinking if they're doing something green, then they must be ahead of the change curve that's coming, because no one in the world that I speak to now in terms of investment land believes the future will be the same as the past. They all believe change is coming and it'll be clean and green. It's just a matter of how quickly it's going to happen and who the winners are going to be. They can't figure out who the next Tesla is. Understandably, it's hard. We've got a lot of change. What you do know is that stuff that's in a green universe is basically very low risk of being negatively impacted by policy change. So therefore, there's a beneficial aspect to it. And that's leading to a whole lot of changed behaviors. So in the fixed income space that we work in, which is growing fast, we have strong demand showing up in price. Now, I need to be careful here because price is not driving issuance. Price is following issuance. In other words, it's not a driver, it's a symptom, if you like. Now, there's maybe some changes that I was doing a talk this morning in Moscow, and the Moscow City Council issued a green bond recently. They got a 20 basis points benefit on primary in Moscow. There's no liquidity. Normally, you need price discovery and liquidity before you get it. In Egypt, where there's only one green bond issued by the sovereign, it's trading in the secondary market at a 75 basis points advantage to the green. So, and so it's not just the UK. The Europeans issued a green bond, 12 billion euros inside, not that similar to British. They got the same 2 bips benefit. They got 11 times oversubscribed. So this is the story around the world. So you can look at this in a growth spectrum. You can say, okay, something's going on here. And this is China, Indonesia, Nigeria, Brazil as well, by the way. It's not just the rich countries of the world. The problem in the fixed income space is a lack of supply, lack of green infrastructure, fixed income, clearly. This we need to get to market. Now, in terms of the gross asset allocation, yes, we might hit a ceiling when it comes to sovereign allocation. We might, although I'm not convinced, because the scale of extra sovereign issuance in the past 12 months has been extraordinary. It's busted all records, busted all limits. I mean, admittedly, a large chunk of that has been bought through QE programs, but no matter.
Can I ask a question on that, actually, if that's all right? Because one of the things that strikes me is, I actually really like something you said just now about the fact that there's going to be no policy arbitrage over this. Everybody is enthusiastic. There's going to be no change in the regulators are going to be supporting this. You're not going to end up with something that isn't going to be following the future in terms of policy and regulation. That's great. But who's buying who bought the gilt, right? Who bought that green gilt that the government issued? Because I know at least 2 of the largest pension funds in the UK declined to participate. So USS and BTPS, both on record saying, yeah, we looked at it, we decided not to do it. The greenium was too high, one reason. Second reason is because tax arbitrage means that just because it's called green doesn't mean it can be used for green. That's the second point. So there is always the issue that you're investing in a green gilt that doesn't get spent on green things. That's a problem. And the third part is the one of measurement. I think one of the most overwhelming things that I've heard in this whole event has been data is weak. So how do you prove that it's doing the thing it says it does? How do you differentiate between something that is supposed to be green that isn't, and something that's supposed to be green and is? And therefore, you may not be investing in something that fulfills what you see as your obligations as a pension fund trustee to invest in green things.
Right.
Data is weak.
We'll definitely have to have you back for that panel.
Can I just come in there? I mean, one thing I think you're absolutely right. For a long time, the UK government has hesitated about issuing green gilts because of exactly the thing that you've highlighted.
Which one?
The fact that not the price they always felt would be good. You do need to make sure the resources that are received are spent on green initiatives, of which there are a lot, and so you can be secure that is happening. And that's why they're not immediately issuing another 90 billion, because you do need the projects and the investable projects.
So how will that be assured?
Well, coming back to the 650 billion of investment that we require, 50% of that, if you look in the rearview mirror, 50% of the UK's infrastructure has been financed privately. And it's been financed by using the regulated asset-based model. So water companies, energy companies, historically as well, airports, although they're not now required to be RAB-based models, because actually there's enough market pressure to keep prices down in terms of landing charges. But we've also used contracts for difference as well, very successfully in offshore wind. So we do have mechanisms in the UK, which many of the pension funds here will be invested in. Actually, it's pretty unusual to find a major pension fund who does not have some exposure to a UK water company or indeed energy company, national grid.
Good.
And indeed for offshore wind, the 12 gigawatts, we want to go to 40 gigawatts. If you look at the Prime Minister's 10-point plan, absolutely that is perfect for institutional investment, both fixed income, debt side, but also the equity side as well. So developers are often developing, taking the construction risk, and then selling down to institutional investors, recycling the capital to do more.
How big was the largest offshore wind farm in the world, the Thanis Array? How big is that?
That is 2.25 billion, 2.25 billion. And if you look at, we've got
pounds. Okay.
Yeah,
And how many gigawatts? How many gigawatts is that?
From memory, 4 gigawatts.
So you need to find 10 of those to
No,
be
but
able-
hang on. I'm sorry. This business about where the money's going, this has been very clear. I'm on the advisory committee for the Green Guild. And also, it's not the first one. The Guild is way, way late in the piece, right? The Netherlands has done a sovereign green bond, a certified climate bond. We had a look at it, where money is going towards adaptation, largely to adaptation measures, to coastal defence measures, which are absolutely in line of what we have to do. In the UK, there's a wide range of investments and tax credits and other support from everything from hydrogen investments to transport investments to energy investments that make up the basket. Now, they've got quite a large basket because they're about to come to market for another 5 billion sterling sometime in the next 6 or 8 weeks, the time of COP, because they're committed to 15 billion sterling a year. The Germans are committed to 10 billion euros a year, et cetera, et cetera. Now, of course, I want the excitement of them to try and find new projects, because the whole point of all of this is to create from my perspective, create an internal dynamic to green the expenditures of government and so on. And it was a challenge for them. It took them quite a while to get together. But there's a lot of paperwork around this. And whilst there may be a couple of investors, put it just in the same way, Allianz came out and said a couple of days before the Green Guild came out, oh, we want an illiquidity premium here. And then it got 10 times oversubscribed at a premium. I mean, it's old news, Chris. I'm going to say it's old news.
There's a whole lineup of paperwork and confirmation, and there's a use of proceeds report at 1 year to show you where the money has been expended that comes out of all of these. This detail.
It doesn't sound like it's scaring anyone away.
It certainly is not. On the contrary, we've got a large investor base in our organisation, and the European bond was more worrying. And I had a lot of conversations with one of the world's largest asset managers, I won't say the name here, about is it right, is it wrong? But in the end, we went back to the Europeans, asked for clarification, and they gave the clarification, which they then released to the public afterwards. And we thought, okay, it's good. So that dialogue is happening, absolutely. The assurance is coming through. And there was, by the way, quite a dialogue with the UK, the DMO and HMT about this too, because the first crop of information, you thought, well, what do they mean by blue hydrogen here? And in the end, I went in and actually it is CCS. It does meet the European taxonomy standards. It does involve measurement of leakage factors. So we were happy, and we're telling the market that.
We're at a pension fund conference here.
Sean's more passionate about me about it.
So we're at a pension fund conference here, and the question here is, how can we get pension funds? That was the question posed last night. How do we get pension funds to invest in the green economy, right? So there's the supply side, there's the demand side. In my mind, I'm trying to square this. I know 2 institutional investors in the UK, to hark back to these 2, but there's more than that, who represent something like 7 to 8% of the DB market in the UK. Between them, said no, because they weren't happy.
And do you see that as a hard no forever?
Well, I don't know. That's the problem, you see. So in my mind, what I'm trying to do is to figure out from the demand side how they invest. Because
give me another data point, Chris. In the secondary market, and the reason this is happening is not sentiment, right? In the secondary market, green bonds perform better. I mentioned the Egyptian market. That 75 basis point advantage is 3 times what it was at primary, because people are seeing these as a premium product. In the downturn last year in March, when bond markets globally froze up, green bonds stayed liquid. You could continue to trade them. If you're a defensive fixed income investor, this is gold dust.
I'd say it's even better than that, because normally if you're a new issuer, you put a benchmark out there, you normally pay a premium, whereas it was pricing inside.
But it is because the
So
secondary market
that
benefit.
to me is one of the most important points, right?
Yeah.
Liquidity when there's no liquidity is a
Yeah.
very good reason for pension funds to
And
invest.
how unusual
Just
is that?
saying enthusiasm for £10 billion doesn't cut it for me. If I was a trustee sitting there, I'd think to myself, that still doesn't match my obligations as a fiduciary. But liquidity, that counts for something.
Liquidity and secondary market valuation.
Yeah.
Because they trade at a benefit. So if you've got a portfolio of marking to market, these things are worth more.
Yeah.
So the decision on price benefit, I'm going to say, which is a symptom of the change, is a harder decisions. I don't get people in the investment side saying they're doing this for sentiment. I get it because they're saying in their portfolio, these are valuable products. And that's the way it should be, of course.
Mhm.
And that's why it's a sustainable change. It's not a one-off change. So for pension funds, and by the way, Dutch pension funds have been leaders in green bond investment for the last year. I've just come from NNIP down the road, a fund manager in that case.
Yeah.
They are probably the most high profile. But APG and PGGM and others have also been big investors in green bond, driving it. It is on the basis of the valuation they're seeing in their portfolios. They were skeptics at first. The first time I had a meeting at PGGM some 8 years ago, they were saying, yeah, okay, sure, come back in a few years' time. And now they're very big holders. In fact, they will happily come out and speak to me. I took them to meet the Indian government to say, we want a rupee green bond. And they said, we want a rupee green bond. We're PGGM, give us one. Because of the benefits they see, more than just pricing as well, but the valuation benefits are substantial.
Yeah, so that makes much more sense.
Yeah.
To me. I like that.
Let me ask you about the skeptics. How are you going to get to the skeptics? Or do you
Well,
worry about them?
The issue with green gilts or govies,
Mhm.
I agree. They're brilliant pricing.
Corporates too.
Possible.
Yeah, I prefer corporates to govies, though.
That was where I was going.
Exactly the same
problem is
data.
that is taxpayers who are paying for that. There needs to be for the energy transition a sharing of the cost of that between consumers, taxpayers, and I would argue investors as well.
And
Investors sound like they're doing their bit. They're pricing things more tightly than benchmark gilts or other government bonds. But the way that the regulated asset-based model works in the UK, or indeed the contract for difference, is to actually spread that cost across consumers and the system as a whole.
Mm-hmm.
That is attractive to investors because actually they recognize that people who turn switches on or indeed pour water into their glass recognize the cost of it, which again is good for the energy transition and the overall use of resources. And therefore, if one can still get investment grade or attractive returns to equity investors, it's still attractive to institutional investors, possibly more attractive than gilts or government bonds, because there is a higher return because there's an element of risk in there. And I think we need a diverse kind of open approach, and that diversity will in itself create resilience. At times, as we've seen with COVID, governments have to issue more, and therefore, arguably, you can't just continue going 2 trillion, 3 trillion, 4 trillion to fund the energy transition. So using private sector, using consumer payment mechanisms as well, really important. So having that resilience, having that breadth of opportunity is really important, I think.
And how do you get it?
Hang on, there's another really important aspect of this, why this is important. We have to change the world's economy on a dime. The only way we do that, because pension funds can't take on the risk for the planet, it's not going to happen. It needs a close working relationship between public and private, with public sector picking up risks they can take. Do it because we can't do it. Public sector money. The sovereigns won't cut the mustard. You're right about the broad asset allocation here. So unless we have this very close working relationship with governments picking up the risks they can pick up and leaving pension fund with a bit of risk which is manageable, ain't going to happen. We are stuffed as a planet. If we do more of these kinds of infrastructure investments, we can move the money. And, we'll bring this out at a risk yield, which will meet the appetite across ratings levels of pension funds. At that point, we have $100 trillion to deploy. We have the capital to deploy at these kinds of public-private deals. So I'm going to say this is more than just making investable. This is actually utterly critical for our society.
That I absolutely agree with. But I also suspect that focusing on just one of the levers is probably not the way to do it. And like a lot of these things, if you want to make a lot of changes, you make a very large end result, you have to tweak a lot of different things. So to my mind, finding the micro changes that you can make that people can wear individually, but add up to something which is very big is very important. So you mentioned something there. You talked about that the pension funds have to share in the risk. I think most pension fund trustees will say that we don't have to share in the risk because our fiduciary responsibility says that we absolutely must not share in the risk. Our job is to make sure people are wealthy in old age. That is it. And we will not compromise. And the Environment Agency had a very, very good soundbite. There was the path to net zero was a very interesting infographic that was produced in the UK to help pension fund trustees understand what was going on. And there was a little side loop that says that pension funds, should they choose to do so, are more than willing to do a little bit extra just because it's a charitable endeavor. And the Environment Agency in the UK came down on this like a ton of bricks and said, we cannot support this infographic because we will do nothing that is, we are the Environment Agency. We understand the problem. We invest in the problem. We are the heart of the problem and the solution. But we will do nothing that takes us away from our fiduciary responsibility. The two have to go hand in hand. And so sharing in the risk is not something they will do if it compromises the reward. The two have to go hand in hand.
No, it's the risk yield. I mean, you share in the risk to get a return. I mean, that's what risk
and that's the whole point, right? So how do you tweak all the different mechanisms? One of the things I was thinking about is it possible? There was a period of time when we were looking at government subsidies, rather than issuing bonds or gilts. Can the government not support some of the other mechanisms to help reduce the cost of capital, improve the return? So tweak on the other levers that may be acceptable rather than piling into infrastructure investment, £650 billion, or government gilt issuance, whatever that may be, £10 billion, 20, 30 in the future, because that's a hard pill to swallow. But tweaking something over there means you don't have to do so much of that or so much of that and expect that risk to be carried by the pension fund.
Which can be regulation or can be first loss provisions.
Correct.
I mean, FMO has done a fantastic thing here with the Climate One Fund, which is a classic structured fund, which is providing some junior risk, if you like, and allowing pension funds to come in behind them. And of course, that's one of the models that's being used in the UK. So absolutely correct.
I think subsidies are being used, but they can't be used everywhere. If the taxpayer, so subsidies are going to be used and are being used, for example, for the transition to EV vehicles.
Yeah.
If you do it for everything, then actually you just really your green gilt issuance will go up and up and up, or your taxes will need to go up, probably do need to do as they are at the moment, partly for COVID. But again, I come back to you need a multi-source and multi-opportunity from a investor perspective, but also to do everything, you need to share the burden across the system.
Well, let's
just
talk
come
about-
back to,
Oh,
can I
go
just
ahead.
come back on the resilience point?
It's fine.
It's good. And what you said about the Environment Agency is really interesting. The discussion this morning about what resilience means to the pension investors. So that session, I honestly thought we were going there to actually talk about climate, because Climate Change Resilience Institute, for example, as we build up to COP, Mark Carney is getting financial institutions, not just pension funds, but also banks, etc., to sign up to resilience measures. And he's doing work on cash flow analysis to say, if we don't fix the climate, pension funds, you can invest in a 25, 30-year bond, but actually, if due to climate, your counterparty can't afford to kind of meet the obligations because of climate change, that is bad news. So how do we do that evaluation? I would say in the UK, we're starting to say, how do we do the defense as well as the attack? The attack is energy transition, investing in nuclear, obviously in renewables, carbon capture and storage? How do we do the defense in terms of flood measures, dealing with climate in terms of agriculture, etc.? What the Environment Agency, frankly, is doing. Also on waste, etc. And I think that element of resilience is going to be more and more, and getting investable products into that is going to be really critical.
And how are you doing that?
Well,
Ben Caldecott
What's the plan?
Ben Caldecott might have the answer.
so certainly in terms of agriculture, forestry is an obvious one. I do honestly believe, and also flood defences as well, bringing in private landowners who have a vested interest in improving flood defences, because obviously their land is being affected, therefore the value. So they absolutely, at a community level, local authorities and private landowners invest in flood defences. That's a win-win. I do think this is an area where carbon pricing is important, because again, investing in absorption of carbon, whether that's through forestry or indeed utilizing other ways of carrying out agriculture, is really important. And that will, I think, increasingly become part of the resilience.
Physical risk is really important to consider, because that's what will impact the pricing of the assets that you hold now. So we saw Ben Caldecott online yesterday, the Centre for Greening Finance and Investment. So that started off in the insurance sector, really the proprietaries of physical risk in terms of the assets that we know and love, right? They think about physical risk. They think about extreme events and the impact that extreme events have on physical distribution of assets. There is a next extension you have to make, which is if physical risk is embodied through flood, damaging assets, what is the impact on the underlying price of the assets that those physical assets represent? In other words, if you hold a portfolio in an underlying, the portfolio value will change dependent upon the physical risk that is embodied through the models that Ben has. Now, there's something that hasn't been done, which is how do you model share price impact of physical risk, right? That's
Getting back
part
to the
of
that's
exactly how do you do that. But it's really important. If we don't model that and understand it, you won't understand that, for example, and it's not an environmental risk, it's not sort of a climate change risk, but Fukushima. When the Fukushima, the tidal wave wiped out Fukushima, it wiped out part of Apple's distribution and Apple's production facility for the chips for iPhone 3. And as a result of it, the distribution of iPhones around the world stopped.
Well, the whole supply chain.
The whole supply chain was disrupted. Now we need to understand that. We need to understand what the
But
physical
do you build
risk
an
is.
investment product based on that? I mean,
Well, you have to make decisions about it. So
How
this
do
again
you
was the
decide?
Environment Agency's thing, which is we want to understand this.
Yeah,
We want to understand. It's not about climate change. It's about climate risk.
Yeah.
I think also it's linked to health and healthcare. I mean, if smart cities, investment in infrastructure, ensuring pollution is minimized, both energy and also transportation, that is as important for actuaries and pension plan holders, but also for insurance as well. So your infrastructure investment decisions are absolutely critical.
Absolutely.
It's absolutely critical to look at that through multiple lenses.
But are they looking at them now, or is there a need to really broaden
In the physical infrastructure, there's a lot of work happening
Okay.
underway at the moment. And we've got banks around the world that are washing their whole property portfolio through physical infrastructure risk modeling to look at how to change the risk calibration around mortgages, for example. These mortgages have got
That's
more
interesting.
chance of being flooded. Barclays has done this, for
Yeah,
example, but in multiple countries. And the data's there now, so you can do that kind of stuff. Tools are becoming available. With infrastructure, we can certainly do that. I mean, like National Rail, for example, some of its railway lines near the coast, have a very high degree chance of being flooded. And that's just a simple thing. There's going to be an outage, there's going to be money lost. And this has happened around the world. Where it gets really complicated is beyond the physical risk stuff, because we've got a lot of physical risk data. And of course, this is incredibly pertinent to long-term investors. Now, why pension funds? Because pension funds have a long-term horizon built into their fiduciary responsibilities. They need to match their assets and liabilities 40 years out. And it's hard because most of our portfolio management strategies are 5 years out. And so we've got to bring in different layers of information. And we now know, let's look at the pandemic, for example, which is something that's born out of the collapse of biodiversity. deforestation in China and South Asia, forcing bat colonies together, pathogens jumping between species. You know, it's not a surprise because the IPCC Health Committee has been predicting this for 30 years. We know it's going to happen, and it's going to happen again. And that's the key point. Now, so what have we learned? Well, we've learned one thing. If you don't have free healthcare quickly, people keep working. And if you don't have income support, like sickness benefits in the US, people keep working and the disease spreads and you get a bigger economic outage. In fact, there's a whole lot of lessons out of the pandemic for how you manage an economy sustainably in the face of volatility and crisis. That is social economics. So suddenly we're thinking, oh, from a macro perspective, well, if you want to look at the likelihood of an economy bouncing back in the face of future pandemics, we now have 18 months of fantastic data. I can tell you which economies are better prepared. It's not the UK, unfortunately, but hopefully they will learn out of this. It's not, and Netherlands hasn't been that good too.
But there's hope.
Taiwan and South Korea, fantastic. We can learn. And now, if you're a pension fund investor looking at country risk, you want to model which countries are learning. And that suddenly becomes a data point that this guy is going to deliver for you, and so on and so on. And it means that there's a bunch of data points, which we would have previously lumped into a broad basket called ESG, which have suddenly become really substantive and short-term in terms of being able to make assessments as a result. And the SDGs, which are indicators of resilience of a society. The education of women, for example. Did you know that there's a direct correlation between economic participation of women in a society and the resilience of that society in the face of shocks? Inequality, in fact, is affected by that. If women participate after a big typhoon or a flood, it recovers faster. Simple as that. And what's the prime determinator of participation of women in the economic life of society? Education. So if you're not educating people in primary, actually you've got a climate resilience problem. These are the things now
I like
we can start bringing into the
I like the idea that we taken ourselves away just from environmental factors, we're moving into factors and so on.
Yeah.
Well, it's environmental. It's really to do with climate.
Well, you know, maybe
That's everything else too.
But I think some of the S factors, we have to think about those as well.
Or new bucket.
And yeah, and so when I think about data, and of course I love my data. The data that we have on some of the S factors is more robust than any of the data we have on the E factors.
Oh.
You know? So
Taking us away.
No. I want to finish this is one thought, right?
Carry
Some
on.
of the most robust data we have is on gender diversity. It's been a theme that's been followed for decades. So and again, to your point about looking at diversity and the impact of education and properly diverse societies and the way in which they deal with things, we have more data on the S factor of diversity than we have on almost anything else.
Interesting. I have a quick data question for you, though,
Yeah.
since that is what
We'll
you
have to open my laptop.
live and breathe. I don't think so. I bet you know this one. So just as far as the institutional investors getting into green finance, what are the asset classes that where are they now and where do you see them being able to go?
Right. Okay. So the data that I've
And then
got.
Matthew, tell them where to put their money.
Yeah. Okay. So what I see is every fund that we collect 15,000 data points across the UK from about 1.3 trillion of assets. That's 15,000 products. All those products are tagged, right? They're tagged as it's a green fund as opposed to a not. It's LGIM's Future World versus LGIM's Not Future World, and I can give you some statistics. It doesn't matter who the manager is, but there is a premium, a cost to buying, certainly in the equity space, anything that's tagged as green. My data also does not support the fact that it gives an improved return. The return of an equity, a passive or an active equity fund that is tagged as a green fund, I don't see any evidence that it gives an improved return. It just costs more. That's all.
So far.
So far. So that's one statistic. I'm trying to think of the number now. Didn't really think about pulling this together, but about 20% of the products that I see funds buying in the equity space, so pension funds buying, will have a tag which is something to do with ESG or green. Haven't drilled any more down into it because we don't have the tagging system to be more specific, because everybody has a different name for a green fund.
Well, that's true. But what about infrastructure? Because I think everybody here really wants to hear about.
Okay, infrastructure. Again, because when pension funds buy an infrastructure fund, very rarely will you get to understand what the assets within that infrastructure fund are. It's not possible to determine what percentage of the assets within an infrastructure fund are green or not. What I would say is that because these are long held things and there's very little substitution most of the infrastructure funds that are currently being held in the infrastructure space probably have very little green in them.
Mm-hmm. And Matthew, what are you seeing in the infrastructure space as far as what's there or could be there?
I think the discussion that we were having over lunch was the kind of, is there the capacity there in the kind of UK?
And we agree that tagging is not great in terms of the data.
And that the tagging is not great. I mean, I just look at the amount of ownership of UK infrastructure assets, not just by UK pension funds, but also the Canadians, the Australians. Talking to APG yesterday over dinner, ports, airports, they like the stable regulatory
the
legal
UK is a
framework.
great place to invest. There's no doubt about it. But you,
Japanese, the Koreans.
But you're about 50% of where you want to be. Is that what you were saying? What's the 50%?
Well,
marker?
the 50% is historically how much infrastructure has been financed privately, and we see that continuing.
Okay.
In the UK.
In the UK, it's about 2% for DB funds, or £31 billion worth of investment by UK funds into infrastructure. Although we agreed that some of the things that I would call real estate might also be called infrastructure. But it's between 30 and 50 billion pounds. That's it.
With due respect, that's why Matthew's here.
Yeah.
Right.
UK
solve it.
investment in infrastructure is poor. The understanding of the resilience, I'm going to say, amongst UK investment circles, as asset managers, is low compared to Canadians, who I have a lot of contact with, the Dutch pension funds and other pension funds around the world. So in a sense, the UK, which is actually doing very well on planning of resilience infrastructure, needs overseas investors to make up for the shortfall.
Well, there's the exciting
UK investment.
You've got 650 billion pounds worth of projects you've identified, of which, even if we substitute out the 31 that the UK already holds, you still have 620 billion pounds worth of opportunity available to every other pension fund in the world. That's got to be an opportunity, right?
It's certainly not. And I would, if Legal and General in the room, then actually I would say that the UK investors are M&G as well. Not to let's keep it no advertising here. Are actually big holders of fixed income in water companies, etc. If anything, I'm not sure I fully recognise the numbers, and there is discussion around asset allocation and possibly doing more in alternatives as well. But Nigel Wilson to actually give the CEO,
Come on up, Nigel.
CEO of LGIM is absolutely behind.
He actually checked over his shoulder to see if his boss was behind him.
And I think actually the UK investors are doing a lot, but we are based upon the experience, and we want to replicate this in an attractive place for people to invest. That's why we're using the structures to actually develop additional investment in the future.
So I strongly believe that there is a naming issue here. What I think of as infrastructure has been nominated by either the asset manager or the institutional investor as infrastructure. The things that you call infrastructure expand to a wider data set. It may be private debt, it may be a liquid credit, it may be real estate, and therefore the pot is potentially bigger. But an infrastructure fund is an infrastructure fund. And that is £31 billion in the UK. And that's an absolutely 100% accurate number because of the data, unit by unit built up. But
I agree there's a taxonomy thing, even between public and private. That means slightly different things if you're looking on the demand side versus the supply side.
But the question is, will the pots be expanding? Do you see the pots growing?
Absolutely.
For green finance. Yeah. And
the pots are growing enormously, but I want to say something about fixed income space. I can't comment on the equity space.
Yeah.
But in the fixed income space, the drivers of growth of this market have not been mandated funds. There are plenty of mandated funds. They're growing all over the place. BlackRock announced that $1.5 billion recently. But in fact, the bulk of investment initially and demand has come from insurance funds in particular, but some pension funds switching. That is mainstream funds deciding, actually, I've got an opportunity here with risky yield comparison to switch part of my portfolio from vanilla to green. I might go for 8% or 20%. And they've been the big drivers of the market. Now, that's a very important, that's not going to show up in your data. It's not going to show up in your green instruments. And if you not only insurance funds, but also central banks. We've had a whole lot of central banks around the world who've introduced mandates for greening their portfolio as distinct from a green portfolio. And that's a very common story. So I suspect it's under the radar.
I wouldn't disagree with it. And part of that, actually, there's a transparency issue. What I'll say with this is, I mean, I've got data on 1,000 pooled funds. And those 1,000 pooled funds are the 1,000 pooled funds that are bought by the, how many clients? Just over 1,500 clients that I've got in the Clearglass database. Those are institutional investors. They buy into pooled funds. They're the same pooled funds in terms of the holdings that are bought by other investors all over the world. So I've got the holdings data of 1,000 pooled funds that can be reflective of not only the stuff that's owned by UK asset owners, but American or Asian or whatever. It's the same pooled fund. Makes no difference. The share class is different, the price is different, but the assets are the same. You come to infrastructure, you come to private equity, you come to private debt, trying to get to the bottom of what's being held either in an illiquid fund manager's book or within a segregated mandate that's held by a listed manager is virtually impossible. There is a code of secrecy around that means it is almost impossible to judge whether or not you asked me what percentage of it is green. But the answer is they won't even know.
Is that
Right.
something, Matthew, is that something you're addressing?
Well, I think, so take sovereign wealth funds. Masdar, which is the renewables arm of Mubadala, the UAE's sovereign wealth fund, you're not going to pick that up. The fact that they're investing in an EV charging fund alongside the UK government, and have now, you can read the FT, so they're now investing 400 million in city fibre, ultra-fast broadband infrastructure as well. So your stats won't necessarily pick that up.
Well, let me ask you a question. So HS2, what's the price? What's the price of HS2? 100 billion something?
That's publicly financed.
Yeah,
So
that's fair enough. But let's just say,
phase one is 35 billion.
But if it was privately
financed, a red
financed,
herring, isn't it? I mean, we're arguing about demand, but actually, all the key indicators of demand, forget what the analysis, what the market should be saying, are very, very clear. Investors are buying up green in droves around the world, always subject to sensible risk yield, which is why you need the public sector doing risk mitigation. So look, I don't think there's any discussion to have. I think it's a waste of time talking about demand. The issue is, how do we deliver more of this? Because what we need to do is to green everything.
How do we?
Well, it is going to be, as I said, a close working relationship between public and private. It's going to be blended finance measures. You're perfectly right in saying there are regulatory steps. I mean, for example, Europe banning incandescent light bulbs makes Philips' old LED division look a lot better. That is useful. Let's not dismiss those kinds of things. They're useful. The risk mitigation, of which the Dutch government, or the FMO, but also the UK government through various institutes, including Guarant Code that does credit guarantees in emerging markets that I work with, these are important instruments as well. Regulatory measures by central banks. I mean, I did a presentation this morning to Hungarian Central Bank, who's brought in risk rating differential and capital ratio requirements of banks for green property bonds.
For bonds?
Nice measure. Bank of England hasn't got there.
In Moscow and Jamaica.
Zoom is a wonderful thing. Zoom is a wonderful
Are you really here?
you came in from Amsterdam this morning as well. So.
Well, we do have 1.5 minutes. I would like to ask each of you to take half a minute each and talk about the supply or the opportunities that you see and your bit getting there.
The opportunity is unquenchable. We could place 10 trillion of green bonds tomorrow if we had them. The problem is getting them out to market, and that is about the government being active in picking up risks to make it palatable and work for pension funds portfolio. We're beginning to see that now. Okay. We've got to see a lot more. We will see a lot more, which means the opportunity is going to be great.
Great.
So we're working on, we've got a 10-point plan, the Prime Minister's 10-point plan. We have 650 billion of investment happening over the next 10 years. We're putting that out there to the market and saying, come along and help finance 50% of that. We're going to put the regulatory and financing structures in place to help facilitate making them, I agree with you, investable projects, both equity and debt.
Okay, on both sides. And any sense of the calendar for that, or the schedule for that?
We're going to be announcing just in COP the first 2 clusters in carbon capture, utilization, storage. So we've been working on this now for quite some time, on CCUS, on new nuclear, on hydrogen, on on zero emission buses, on sustainable aviation fuel. There's a lot going on in the UK. Come and look.
Well, the pension minister, Guy Opperman, told us 2 days ago that it's all about COP26. That as far as the UK, all hands on deck in the UK.
Yeah, I'd agree with that. I just slightly worry, and we're building up to that crescendo, but we need that kind of noise to carry on, not just to stop.
Yeah.
So I think that's what we're trying to do, and there will be really strong investable projects, which is not just attractive to. It's really important that institutional investors have industry alongside them, whether that's entrepreneurs or whether, frankly, it's oil majors, for example, who actually want to also change their model and bring in that expertise to make, again, those projects investable, having skin in the game as well to, again, make sure they're delivered well, which is what the IPA is obviously really focused on.
And how do you see this all changing your data sets as far as who invests in what? Pension funds investing in what?
Pension funds, we're here to talk about pension funds.
Yeah.
It's a pension fund conference.
Yeah.
They've got to be offered the opportunity to invest in the way in which they invest. And they obviously don't want to invest directly in green bonds. They want to find other ways. So we have to give them the opportunity to invest in other ways. And after the fact, it has to be measurable and achieve its objectives. And the two weaknesses I see here is that developing projects and expecting people to invest in them the way they do is complicated because they don't necessarily meet the criteria and fiduciary responsibility of fiduciaries. And then after the fact, because you have a fiduciary and reporting responsibility, you have to be able to prove that it does what it says in the tin.
Right. Yeah.
And again, I see a problem with that. And that's a taxonomy. It's a nomenclature. Even my taxonomy obviously is not quite right because it doesn't match the numbers that you see. So there is a problem. And we have to do those things and make the logistics, make the mechanics of this work. Otherwise, you're not going to get pension funds picking this stuff up. And not, maybe they will do, but not certainly in the capacity or scope that you want it to happen.
Well, you did say you have an optimistic note to end on. So I'm going to let you have the last word.
Well, I do think, listen, this is not just about the UK as well. There's a lot happening across Europe. When I look at things like hydrogen as well, I'm equally looking at what's happening in the US or Norway, or indeed the $1.5 billion that's been raised in France. So I think the great news is this is happening across the globe. There's a lot to share, there's a lot to learn, and there's a lot to cooperate on. I absolutely agree with the sentiment. This is public-private partnerships in the broadest sense, but you know that's every layer. It's not just about institutional investors and government and regulators. It's also about industry, and it's also about pension holders. It's about us individually, about the changes we're going to make in our lifestyles as well. And I think we all recognise that there's a huge amount happening. 10 years ago, still noise, but now it's really action, and we need to do it.
Good.
And that's the optimistic note.
Good. And we look forward to following up on that. Thank you, gentlemen, very much.